Fellow investors, tell me how 22 has been treating you and your portfolio. I know that's probably one of those kind of year that you just want to put in a basket and never talk about it again. In fact, as you can see on this graph, it has been a rough time for American investors, or if you're Canadian, you invest in the US market. The market went down in bear territory. I'm not sure if we can talk about a market crash. I mean, it's still minus 25 at the worst point. Here you can see is total return for the SPY and XYU, so tracking both two ETFs, tracking the S&P 500 and the other one tracking the TSX 60. You saw, I mean, Canadian has been very well served with the oil and gas sector. The thing is, that's pretty much the only place where you could put your money in 22 and make money out of it. We had amazing vertically integrated companies such as Canadian Natural Resources. We have a bunch of exploration companies, and also we have great pipelines like Enbridge and TC Energy. So all that combined together was enough to lift up the TSX 60. Keep in mind, the Canadian market is not well diversified. So whenever banks or resources are doing well, the rest of the index will show good results. As for Americans, well, I mean, tech stock has been taking a big beating. The Nasdaq was down by more than 30% at one point, and that hurt a lot. So today I thought, how about I show you how my dividend portfolio performed throughout this year and since I started it in 2017. Of course, I've been investing for a lot longer. Actually, my first trade happened in 2003. So I have been investing 100% stocks, 100% invested for the past 19 years. However, what I record on my blog on a monthly basis, so on the dividendguyblog.com, every single month, I report my pension plan income, dividend income and portfolio. Why? Because this one, I cannot add capital to it. It's a locked-in account, so I receive a check that was the value of my pension plan in 2017 when I quit the bank and decided to work full-time on Dividend Stocks Rock. And since then, I can only reinvest capital gains or dividend payments, but I cannot add any dollars to boost those performance, which is great because it gives you a real life case study about what you can do with pretty much 100 grand invested in the market. Back then in 2017, it was like all-time high market as well. So a lot of people were telling me, Mike, you should wait a little bit. Well, you know what? I decided to invest it all in one shot, and then here's the results. So as of December 2nd, before the bell ring, portfolio value was now $209,000. So keep in mind, I invested $108,760 and 2 cents. So making about $100,000 in a little bit more than 5 years. My dividend payment over the past 12 months have been $4,500 for an average yield of 2.15. That gives me an annualized compound return of 13.26, all included. So 13% per year, which is definitely very interesting. And if you compare to the SPY and XYU, so tracking both 50% of the US market and 50% of the Canadian one, because this is how I invested that money back then. The average is lower than 2.43%. So in average, over the past a little bit more than 5 years, I'm beating the market by 2.4% per year, which is a pretty good performance. I'm not here to brag though. I'm here to show you how it happened and why it happened. And actually, it was a humble year for me because I got a few trades that went sideways big time. And I just want to show you how even if you make bad picks in your portfolio, you can still do great and perform well. So the two trades that didn't go well at all this year was obviously Algonquin, that is down 47%, and Sylogist that is down 55%. So, I mean, big shocker. I sold Sylogist when they announced the dividend cut. That is because it's part of my investing rule. So whenever a company cut their dividend, I just get rid of it right away and I don't even think about it. So unfortunately, that was the case with Sylogist. I still understand the narrative where they want to focus all their money into mergers and acquisition, but this is not what my portfolio is about. My portfolio is about dividend growers, and in this case, it's just gone. I have to tell you, I've made 2 exceptions throughout the past 12 years that I'm being a dividend growth investor, because before 2010, I had other strategies, but not including dividend. So since 2010, I'm a dividend growth investor. And over the past 12 years, I only made 2 exceptions, and they happened during COVID. So CAE and Disney suspended their dividend in 2020. Not because they were having problems or they were like problems related to their business model, but rather because their business were closed due to the pandemic. Moving fast forward today, they still haven't reinstated their dividend. I don't think Disney is going to reinstate it like anytime soon. They're using their cash flow to build their streaming platform. It's still burning cash. It's a tough business. At this point, I am waiting for Disney just to see what's going to come up with Bob Iger that made Disney amazing. So he's the guy who's behind the acquisition of Pixar, Marvel Studios, and LucasArts, also Fox assets. So he completely transformed Disney as a CEO. He left and saw that it was not going well, so he's coming back. So I'm going to held onto this one. As for CAE, I expect the dividend to resume in 23. They made a lot of acquisition in the past 2 years. They benefited from the pandemic actually to buy other competitors in their market. So the business is doing better. I'm still making money on this one anyways, but obviously if it doesn't start to pay a dividend, I will have to get back to this strategy and say, you know what, CAE, you're not part of my portfolio anymore. So as for Algonquin, this one has been documented at length. I will drop the line, the link in the link description below, the report that I've made on Algonquin. At this point, I am waiting on Investors Day that will happen in January. Why am I waiting? Well, first, they haven't cut their dividend in 22. They have increased it. But then the latest results were not that great, and their main problem is, and the reason why the stock has plummeted so badly, is the market is very concerned about the debt situation. Algonquin still has a good portion of their debt as floating, so it means that it's variable rate, and as we know, interest rates are going up. Not a good sign. They still need to withdraw a lot of money from their line of credit to complete the acquisition of Kentucky Power. So what happened is when they announced the acquisition of Kentucky Power, they secured their financing on their fixed rate, but they paid off their line of credit in the meantime. So that was smart, but that means that today they're going to pretty much finance Kentucky Power with new money that will be borrowed at a higher rate. What's going to happen with that? What will be their discussion about capital allocation, their capex, because they have like billions of dollars they want to invest in new projects. All of that will be discussed on Investors Day. And obviously, they're going to discuss what's going to happen with the dividend. And at that time, I'm going to take a decision. What I wanted to show you here is even though I had large loser in my portfolio, the overall portfolio still performed well and maintained the cap. One of the reasons why it still did well in 2022 and overall for the past 5 years is due to the sector allocation. So while Sylogist and Algonquin didn't do well at all, they were not more than, I think, like 5 or 6% of my portfolio before they drop. So they affected the portfolio with maybe like a 3% weight that I lost here. But most of my portfolio is invested in information technology, financial, some consumer discretionary, and consumer staples. Those held the fort mostly. In terms of tech stocks, Microsoft and Apple didn't do well, but Texas Instrument was not that bad this year compared to the others. As for financials, I have National Bank and Royal Bank and BlackRock. So the Canadian banks did good this year, so that wasn't too bad. And one that helped me a lot to overcompensate for some losses was one of my largest holding, that is Alimentation Couche-Tard. You can see a video. I just did a video on them not too long ago on the channel. But Couche-Tard did very well this year. It's up double digit. So that helps to mitigate sometimes when you lose some money. And this is, I think, the most important part, is to have this kind of diversification. So whenever you make a bad choice, you do not ruin your portfolio. So now, if you want to know what's really under the hood, I suggest you that you head over to my blog, because I have listed all my position and how much I invest in each of them. You'll see that Sylogist is not in my portfolio anymore. I'm looking at doing a lot more trades as well. So just go on to dividendguyblog.com and you'll get to the latest income report for my pension plan. I want to end this video actually on a more positive note, because we have been discussing a lot of bad trades, down market. It's not a period where you are happy to invest, right? Because you look at all the money that you have worked very hard and it's all gone into smoke. However, one thing that remains is the dividend. So year after year, I'm tracking the dividend that I receive every month. And what I've seen so far is that this amount is increasing every single year. When I compare what I've received so far this year versus 21, I'm up 10.5%. So the dividend growth rate is increasing very fast. Also, the fact that I'm reinvesting those dividends into those stocks to pay more dividend, well, you can see that virtual circle working on, and there it creates a snowball effect. So while a lot of people will tell me, but Mike, you are making like a 2%, 2.15% yield on your portfolio. That's not much. I mean, I cannot retire on that. Well, when you think about that, I started this portfolio 5 years ago, and that $4,500 a year is now 4% on the original amount. So it's a 4% yield on my original amount, and this continues to grow. So by the time I hit 65, this portfolio will likely generate between $35,000 to $45,000 in dividend and alone, and that's only one part of my assets. You know, I started with $100,000 at the age of 36, and by the age of 65, it will generate almost enough for me to just live off my dividends. If I combined it with other account that I have, I'm definitely on the right path. So this is what is most important to focus on, and this is what I would like to let you know today, is if you focus on your strategy instead of focusing on your portfolio value, you will get to your destination, because that journey is like a hiking trip. You know, you don't always like walk on a flat, and it's not always uphill. Sometimes it's downhill for a while, and then you have to go back up and then go back down again. And this is the story of any investors. The point here is to never give up when the market goes down, and instead think about how much dividend you receive. I just want to end this video with this last graph, which shows the cumulative dividend payments that I've received since I started. So as you can see, obviously it's always going up because every month I'm receiving a little bit more. But just to show you, I've received almost $20,000 since I started investing this portfolio, and this amount will grow even faster going forward. So this is money I didn't have, and I didn't have to work for it. So right now, it's not that impressive. It's like less than $4,000 a year on average. But going forward, this portfolio will generate 5, and then 10, and then 20, and then maybe $30,000, $40,000 in dividend every single year. So, all right, I hope that you have enjoyed this video. Don't forget to give me a thumbs up. Give me a comment about your portfolio, your performance, or what you would like to see about this portfolio that I'm reporting every month. Let's start a discussion. Help me grow this channel. And until the next video next week, don't forget to stay invested.